Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 22nd, 2019. I hope everybody had a nice long weekend, especially those that took Friday off. Stock markets were closed for Good Friday, so that's usually when I'll take a day off on market holidays. And so now we're back to trading. We have a full week this week, not only a full trading week, but a lot on the calendar, both the earnings calendar and the economic calendar. So I put out a post earlier this morning. We have a slew of big market moving companies reporting. We have Twitter on deck, Boeing, Caterpillar, AT&T, Facebook, Microsoft, Tesla, Amazon, Intel, and that's just to name a few. There's a lot more behind that. So what I'll do in this video, I want to go over the charts of just really, a handful, maybe a top half dozen or so. Some of those names I just mentioned now, maybe a couple more that have the potential to move the markets, or anything that stands out. See, it's been not a very not at all a conducive environment to swing trading. The market's been inching higher, so it's certainly been a buy and hold market or a buy the dip market. But as far as big moves, where you're probably going to see those, you have the potential in earnings, obviously, because a stock can certainly many stocks will make a big move following earnings. And now there's a few takeaways before we get into that. Let me say this, that this week, because of the heavy economic calendar and the heavy earnings calendar, you need to be a little skeptical for breakouts. Breakouts on individual stocks as well as the market. In this case, when you have such a heavy economic and earnings calendar as we do this week, but particularly individual stocks now, when they're scheduled to report, if a stock were to break out of, let's say, break to the upside from a bullish chart pattern or break to the downside from a bearish chart pattern, you have a considerably higher rate of failure on that breakout if a stock is scheduled to report within the next week or two, especially within a few days. Also, consider this as far as breakouts go. Make sure to check your stocks for earnings, because it typically, not always, but typically, you'll see a stock go into a holding pattern leading up to earnings. The same way the stock market goes into a holding pattern just before a major FOMC rate decision meeting, where you'll see it kind of chop around sideways, but for the most part volumes taper off and the market doesn't go anywhere, because you have most market participants wanting to see what the Fed says. Same thing with a company when they report. Who's going to take a big stake right in front of earnings when it can go either way? It's always a crapshoot. I often say this: if a chart pattern is clearly bullish or clearly bearish, more often than not, the stock will end up going that way after earnings, even if it's not the initial knee-jerk reactions and after hours of the pre-market session. I'm talking the trend for the next week or so. But as I often say here, quite often is not always. So that there's no guarantee. You can have the most bullish or bearish chart pattern. There's no guarantee the charts are going to go that way. So the bottom line is, keep it light. You don't want to take a heavy position, or maybe even not a full position of a stock if it's scheduled to report 2 or 3 weeks out, especially within a few days. Because if you go out 2 or 3 weeks, you trigger out on a long side breakout, the stock may start to move up, but it'll probably begin to stall out. Therefore, chances are it's not going to hit the measured target for a swing trade pattern. You might be targeting a 10-12% move. Stock may break out and then kind of flounder around again as everybody goes into holding patterns. So that's something I wanted to get out there. There's times that the market's conducive to trading and then other times it's not. But from these big, earnings weeks, the earning week like this, and the following week will be heavy too, you can get some big moves. It depends how earnings go. And again, as I always say, it's most important how a stock reacts to earnings, more so than what the company says. I've seen companies blow it out of the water with great earnings, only to see a stock peak at that point and start a new downtrend or major correction, and vice versa. Sometimes, and this is often the case, a stock market or an individual stock usually bottoms on awful news. Think 2009, think the lows, and a lot of companies same way. Once all the bad news is priced in, that's it. And sometimes you get a horrible earnings report, and boom, then the stock just turns the corner from there and starts heading up. Okay, before we get into the individual companies, I just want to do a quick overview of the markets. I think it's important to talk on these technical levels because we're sitting on some pretty important trend lines, some pretty key levels. Markets are very extended. So, what I'm getting at here is don't fall asleep at the wheel because we could be looking at a big move either way. Some are calling for a blow off top. Others, like me, are looking, think it seems pretty clear the charts are indicating a correction, and just because it hasn't come doesn't mean that it's not going to come. We'll see, but I want to go over a few things here. Start out with SPY. Let's keep it simple. Here's that trend line off the lows on late December, and SPY, as I mentioned, broke down last week. There's that red candle. Not impulsive at all, so not what you want to see on a breakout. Volume was subpar, below average volume. The candle was barely closed below the trend line, and since then we've moved sideways. So I'd put a little support level here at 288.83, which comes in and captures a couple candles from last week or the week before. You can see one, two, several candles stopped at that level. Once we broke out, we've touched it every day but one right there. Every day we've stopped right there on that 288.83-ish level. So it is certainly a minor support level to watch. In this, again, SPY is below that trend line. However, the breakdown was not impulsive. It happened right before a bunch of major earnings reports come out and everything else. And most importantly, it was not confirmed with a breakdown in QQQ or XLK, the tech sector ETF. So that's what I'm watching right now. We need to see XLK go. Here's the trend line off the lows on late December 24th there. Quite a few reactions, and you can see XLK is comfortably above the trend line now. When I say comfortable, it's relatively speaking. We've had a lot of price compression, little tiny candles. And I would suspect that if and when these trend lines go, I would say within a week, possibly less, you'll probably wipe out a month of candles. So a month of gains going back right here. Let's see, that would be, if we go back to this point here, let's just go to right here and see what that is. That's about, 20 days right there. That would be my expectation. You will quickly wipe out a lot of gains. So to me, it's all about risk reward. And right now, although the trend is clearly bullish, we don't have any sell signals, so there's no need to be shorting right now. But to go long, that big move down, a good part of it could come on a gap down. So yes, while a well-placed stop would let you be in this trade and continue up, and it may work. You may cross that intraday, and in which case you'd be stopped out. But there's also the possibility to see a gap that goes down below there. There's a lot of excesses in this market right now, a lot of red flags, overbought conditions, divergences, everything else. So that's kind of an overview. And again, unless I see QQQ and XLK both break those trend lines with conviction, we don't have anything remotely close to a sell signal in this market. Right now, this is a 60-minute chart XLK. I mentioned that last week, that this may give you an early jump on a sell signal here, a break of this 60-minute rising wedge. This trend line's a little tighter, comes in closer to prices than that daily chart we were just looking at. And, it's a nice clean wedge. And you can see we've had, going back to, this chart goes back to January. We've had 3 similar type wedges, all with divergent highs, and they've all led to tradable corrections. And the thing is, if this wedge breaks down and does play out, could break down and be a whipsaw signal with a lot of tech stocks on deck to report. So keep that in mind as well. But if it did play out, at least to that minimum target right there, that would take us down through the daily trend line as well. So it could have a cascading type effect there. Okay, and before we get into those components, I just want to talk on market conditions, lack of trade ideas. I thought trade ideas, and they were light earlier this year, and lately they've been non-existent. I'm going to update those finally today. Every trade idea, if you look at it, will list the price target or stop, and if that's hit and I don't modify it before it's hit, that trade's completed. But there's a lot still, that haven't been moved out. I have to post an update and then move them into the completed trade archives. And I have a handful of setups already, actually a pretty long growing list. So I'll start putting some of those trade setups on. What's kept me back on a lot of those. I see some beautiful setups, and when I go to check, in most cases that stock is reporting within the next week or two, or up to 3 weeks, and so I'm hesitant to put on official trades because again, it's a crapshoot taking a stock in front of earnings. Can go either way. So now I can add those as setups, and let you figure out if you want to take a partial position or not, whether it's an active trade, and also how to do that. One way is to take a fractional position in front of earnings. If the trade starts to go your way afterwards, you can add, and if not, you stop out. And therefore, if there's a big gap against your position and you only have a half or 1/3 or 1/4 size position, it's not going to hurt you that bad. So that's the whole point of scaling in or taking a partial position on the stock, and then waiting till the chart's confirmed to add to it. All right, let's just talk real quickly about the market and these what's happened this year and really what happened last year. This is the S&P 500 SPY. In this range here, from 262.23 up to about 282, that was heading into the end of 2018. That was my expected bounce target range. And yes, it's a fairly large range, but we also were coming off an extreme move. So that was the bounce target range for this year. And I want to talk on what happened. So the bottom of that range was, you can see coming here, grab that low. From the lows, it was a 12% rally off the bottom. So I had, estimated 12 to about a 20% rally. This being my uppermost bounce target, about 21%. And so far, the market went up to last week's highs about 25%, almost 25%. And what I want to talk on here, let me grab that video. Here's the video from December. This was the year end, December 31st. Yeah, there it is, time stamped and dated stamped. And you can see there's the range. As I hit play, you can see, I was highlighting my lowermost bounce target up to my uppermost bounce target, and those are the ranges I just showed you there. And I want to talk about, trading and probabilities and statistics and all that boring stuff. Now, that range that I had for the bounce that we've had so far this year, it was a pretty wide range, and that's again because of the extremes coming into it. We had huge expansion volatility, and it was based on a lot of variables. I was clearly unwaveringly bullish at that point, expecting more upside. And so the way I look at the targets and the ranges, sometimes they're a lot tighter. And this is just a bell curve. A bell curve is a commonly used thing in statistics. They use it in the financial markets. And it shows the probabilities, this being the midpoint being the most certain outcome, the highest probability. And then as it tapers off, you can see the percent. And again, these numbers can be plugged in. I just pulled up a bell curve here. It's standard, usually you see distribution somewhere along this line. But the way that those targets were factored in would be, my uppermost bounce targets, or my bounce target range from low to high, ranged in this point here about the highest percentage said that we would bounce there, and beyond there it's certainly possible, but the odds go down. And so what we've seen in the market since the lows in December 24th, it's not I wouldn't go so far to say it's not a Six Sigma event, but on the outliers of probabilities based on historical rallies to that extent, things like that, we are now getting very much stretched out here. So again, the odds that we can go up, but the odds are really against it. And again, the fact that we went up so much without a decent correction, a really 10% plus pullback based on the scope of that move, is very low. And I know that, in just reading it caught just about everybody off guard. Again, the magnitude of the rally. The fact that we had it was not a surprise at all. That was priced into the technicals, just as the top was. And there's a good example, too, on the downside. Again, it's not pure randomness. The correction that we had in the fourth quarter was clearly, at least was coming. I saw it coming a mile away. We identified it with a breakdown in QQQ and XLK when the market topped back in October, and we had, even back then, I had a potential target down here, which was all the way down about 156. You can see on QQQ. This chart is from earlier. When was that? They're all October 10th, right after the market had topped. So those were potential targets, and as we started to get more and more impulsive selling, that opened up the door and the probability for these longer term targets, and again at the time. But just like then, so I was looking for a move down to potentially about 156, and you can see, let's pull up today's chart. And this is QQQ, so there's where we dropped. 156 would be right about here. And so you can see we overshot. And again, that just goes on back to that bell curve. This is where, and that's why I had potential targets. The odds go down, the probability go down, especially for correction that large. And we overshot it by a bit, so you certainly got into the range. And it's not that it couldn't have kept going. This goes and never really ends. There's no 0 point. It approaches zero, but it gets increasingly smaller. In other words, anything's possible down beyond that 0.01% range. So as such, that's the market we've had. It overshot by a little bit my downside projection, and on on the market, the broad market, overshot by about 5 percentage points to the upside. Now, it doesn't mean it can't keep going up, but based on everything, including the fact that this move was priced into the charts before, this move was priced into the charts, we've exceeded both a little bit. It hasn't changed really my outlook on the market at this point in time, and that's the point I'm trying to drive home. It's just slightly overshot it. I know it seems like it'll never go up. I know there's a thing called recency bias. Investors tend to think that the market, because it's been going up, will continue to go up. And hey, maybe, but let's just see what happens this week. We got a lot of potential market movers. We'll go from there. All right, now we're going to roll into the earnings candidates that are on deck this week, and we'll take a look at those charts. And with that, before I leave it, again, this market will, at some point, whether it consolidates first and builds up some, gets a pullback here. There's for example, a great support level, and maybe we hold that support, we work off the overbought conditions, we consolidate some, and it sets, a stage for another leg up, maybe a breakout to new highs. It might be a sustained breakout. Like I said, right now, any breakout that happens in the near term, I suspect, here's an uptrend line, a primary uptrend line that may get tested. So it's the same story. I've been singing this tune for weeks, and it really hasn't changed because the market's just inching up every day, hardly moving up, but yes, going up. And so we're talking, maybe a couple percentage points, I think, if it were to keep rallying without a correction. At most, there's a couple percentage points before what I'd see right now is at least what is this, about that would be a 3% pullback from current levels in SPY, a minimum pullback target. And if we went up there, then you get a drop about twice that right there. So it's about risk reward, and right now, like I said, the reward does not outweigh the potential risk of a sudden swoon down. So I won't fight the trend at this point, nor will I jump on the long side. And I'm talking pure equity. There's a lot of individual stocks, and we're going to get to those now, and there might be trading ops there. Okay, just to go through the ones that I covered on the front page today. Here's Twitter. Twitter's a mess, at least not my kind of chart. This is a stock grinding around in a sideways range, unpredictable range. I can't draw any well-defined trend lines. I could try to force some, but it's not worth it if I don't have enough reactions. So let's just say Twitter, I have zero opinion on. And like anything else, if I don't have an opinion on a stock, that's fine. Move on to the next one. Next up would be BA. I certainly have an opinion. It hasn't changed. We had a recent trade on that was stopped out. But the long-term chart still tells me this one has a lot of downside in the coming year or so. There's a uptrend line a potential uptrend line. Some reactions along the way there. It's interesting, and I've started to update this. I have a screenshot. Took this week. I'll update that trade, but you can see on the last trade, where did we entered somewhere here? We hit that support line. I had a stop right here, which was the top of that gap. You can see that gap there. So it was technically based. There were some reactions. We popped above it. went up, and I had this same resistance line right here on the original chart, 399.29. Look at that. We hit that to the button. We hit resistance, and then we gapped down below. And look how well that stop level is acting as resistance right now. We came back up. We've hit it 1, 2, almost 3 days. We're rolling back down. So what this one needs to do, it needs to break those recent lows. And again, that trade was based more so on the weekly chart. Here's the weekly chart of Boeing. Divergent high 1, divergent high 2. Well, I had a question mark at the time because it wasn't confirmed. It is confirmed now, so the question mark goes away. By confirmed, I mean we now have a bearish crossover on the PPO that effectively put in this lower high right here. And so there's our divergence. This line, this uppermost trend line right here, the divergence line, and this yellow trend line make up what we call a broadening wedge pattern, aka a megaphone pattern, and you also have this trend line right here. That would help, obviously, greatly help, because this trend line and the divergence line up there on top make a large wedge pattern. Maybe it works its way up within this wedge a little more, maybe not, but let's watch for a break of this trend line, and this one's still on watch for possibly for a long-term swing trade. But they report this week, and I wanted to bring it up with these levels to watch, because this is one of the big industrial companies. This stock has a good weighting impact on the Dow and the S&P, so we definitely need to watch this. Caterpillar, there's another one. Heavy machinery, stuff like that. When the economy is booming, construction's booming, and so you want to watch Caterpillar, not just in the U.S., globally as well. So this is somewhat of a canary in the coal mine. You have this pattern right here. This is sort of not a great trend line, but somewhat of an uptrend line right there. Yeah, we have enough reactions. And so you have this ascending triangle pattern. So you have resistance right here, about 144.50. You can see all the reactions coming back here, quite a few. So bullish if it can break and hold above there. Please remember, when they report, there's a lot of what I call post-earnings noise. Sometimes you have a reaction one way, like that, the initial reaction's down, then a breakout to the upside, or you pop above that level in reverse. So you got to be a little cautious right after, because there's trade imbalances and everybody having a knee-jerk reaction to an earnings report and their forward guidance. It takes a while for the analysts to sift through everything they said and market participants to figure out which way they want to go. So be careful. Maybe, like I said, keep things light right around earnings, and then once it becomes clear which way this one's going, tell you this would be you'd have to wait for a break of this trend line to have a good sell signal, although a rejection off that level might get you an early sell signal. Or trading 101, you either short a bounce back to resistance, so you short 144.50 with a stop somewhat above. You go long a breakout above resistance, or you short, the next short op would be on a break of this uptrend line right here. So those are the different directions you can go. So if you're bullish, you want to wait to see, we'll call it 145 taken out. Taken out with conviction. That's Caterpillar. But again, watch it, because it is a big, big industrial company, and important, I think, to the economy. Next up, AT&T. We've had some interest in this one recently in the trading room, and I've shared this as a potential trade idea in the trading room as well. Move that. I was trying to get this divergent low right there. All right, so we had support here. Basically, watch this trend line here. A lot like the market, the broad market, off the lows on December 24th, it has a well-defined uptrend line. It's walking up. No divergence or anything. It is overbought, so it's a little extended right now. You can see some levels, and 3160 is also, move that line down a little. About 31.45 is support as well. So break of the yellow trend line and 31.45 would be bearish, while a breakout above 32.87 or so would be bullish. That's AT&T. Facebook. This one clearly in a bearish rising wedge. I know I have a lot of lines here, but let me just draw this out for you. You can see I have two alternative trend lines. I have a primary uptrend line off the 24th. That's probably the more important of the two, but I can add a BOD, or benefit of the doubt, trend line here. I really am focused more on this yellow trend line off the lows. So that forms a nice clean rising wedge pattern. So to be very clear, if I had to gamble and bet which way this one goes after earnings, I would say to the downside, because you have clean divergence confirming the wedge. However, this is a divergence line. That means it can be extended. So Facebook could pop up. It would still keep the divergence intact, especially here on the PPO, and put it at a higher level. So really no sell signals, but break of that trend line, especially a solid red close, could be an early sell signal, or maybe you get it at higher levels. Maybe it wants to come in here and test the bottom of this gap right here, not too far above, like I said, and extend those divergences. So there's one to watch. This is a trade setup. And here's a case where you broke a trend right here, broke down, and it back tested, a high level back test. Just squeeze out any shorts that shorted the breakdown. But it still did play out. When it played out with a bang. And this is a good example of what happens. That's most likely an earnings-induced gap. Look at the size of that gap right there. Huge. This is why you gamble. And you need to know your company. You need to know the history of your company, any company that you're trading. Know their history after they report. This is a gappy company. These gaps are most likely, I can't tell you for sure, I'd have to verify, but they're most likely earnings gaps, and they're huge. So you might as well go to Vegas and put it all on, red or black on the roulette wheel, because you have a 50-50 chance whether this one's going to gap up. But I would say in this case, because it's a bearish chart pattern, that skews the percentages to this one breaking to the downside. Just like you had here, you had the divergence, rising wedge, everything else, and you can see which way that one went. So, if I had to bet, it would be to the downside, but the safe bet, of course, is to wait for a breakdown there in Facebook. Microsoft, big. This is one of the top components of the S&P 500 and the NASDAQ 100. Clearly wedging higher, negative divergence. Again, sometimes those divergences build for a while, and it's not as if each and every one of these different divergences didn't play out. There were minor corrections all along the way, and finally we had a big correction there. Microsoft actually fared better than most heading into the December 24th lows, but here's what we're looking at now. Nice clean-up trend line, divergence there gives us that wedge type pattern. PPO is still pointing higher right now, so there's, the trend is up. There's no sell signals at all, just a trend line to watch. And again, watch these fangs, all of them. If you see 3 or 4 of these go, then the market's going to go. If only one of these FANG stocks break down, that's not going to take the market down with it, unless the others also follow suit. Tesla, T-E-S-L-A, a lot of buzz on this one. Tesla, for the most part, it's just been in a big multi-year sideways trading range. I know this chart is busy, guys. There's a lot of levels on here, but this is the big range. Sooner or later, it'll break out of that range, but it could go on for, sometimes these ranges go on for years. So right now, go back to where we were on the daily chart there. You can see I have a downtrend line off the highs to watch. Breakout above that would be bullish. And this is more of a divergence line right here, positive divergence. So if that can hold, if these divergences aren't burned out, Tesla may prove to be a good buy here. It's getting down towards the bottom of its trading range. You can see this is support zone. It's not super well defined. That's why I have a support zone instead of a hard line. So if you can buy it in here, closer to the bottom of the support zone, the better, with a stop somewhat below. That's an objective long. And if it breaks down, however, an impulsive breakdown through that level would be bearish. Where would you swing it to if you took it long here and you're not stopped out? Well, you might want to wait to add on a breakout of the downtrend line, and then hold it to the top of the range. As long as the broad market continues higher, maybe we get a little correction in the coming weeks or months here, and then a push to new highs. Tesla could certainly go back to the top of the range. So that would be a long-term swing trading up. And if it breaks the bottom of that range with conviction, you short it, you put a stop somewhat above the top of the range, and you tuck it away, because that would be a powerful sell signal if it broke down again from this multi-year trading range right there. And I'm sure this one will gap one way or the other during earnings or after earnings. Amazon, very, very important stock for the market. It's overbought, divergence on the RSI, not so much on the PPO, but we'll watch this BOD, benefit of the doubt trend line. So let's even take this one away for right now, the uppermost one. There's our trend line to watch. And nothing else to say. We just have to wait and see what happens after they report. Oh, it's at resistance now, about 1875.50. That was support back here. It was resistance there. And you can see the next support here is about 1752. So it's certainly one to watch regarding the market. And then finally, Intel, king of the semis. Divergence potential, only potential. Indicators are still pointing higher. PPO is moving up. That means it could be burned out. But if it reverses here soon, you'll have negative divergence on the PPO. You have pretty extreme overbought conditions. That doesn't mean the stock has to go down, but it's something to note. And if so, again, earnings is going to determine everything here. The stock recently broke out to a new all-time high here. You took out the previous highs, and normally that would be bullish. But here's a great example of why you don't chase breakouts right in front of earnings. Who's gonna pile into this stock when they're reporting this week? They report on Thursday, so therefore that breakout so far there was no follow through whatsoever, and the stock has drifted back down. So it's one to watch. It's either going to hold this breakout depending on how earnings go, and then it could continue to rally up, maybe become more overbought, or it may prove to be a failed breakout. So let's see what happens. One thing to watch, so far we have the potential. It's only potential. The week is young, and we're only in Monday morning right now. We've got to go till Thursday after the market closes, so you won't know until Friday. But there's a potential for an island cluster top. If we continue to trade sideways this week, and then we gap down on Friday after they report, below that island cluster right there, that would give us an island cluster top. Great short setup if it happens. You short the breakdown with a stop. You know, if this market, they love running stops. I have no doubt now. I've traded long enough to tell you, and I could see from the trades that we've had stopped out this year that have just been barely clipped what seem to be well-placed stops. The algos know where the stops are. So, you know, normally on an island cluster top, you can set your stop just above the bottom of the island. But if that happens, the algos, if they can, they'll push the stock up there, pop the stops, and then take it down. So you might want to put your stop a little higher, you know, maybe above the top of the island or right around there. Again, one potential scenario, and there's a lot that needs to be done. I'm getting ahead of myself here because it's only Monday, but that's something to watch for. And then there's a trend line here as well. If that breaks, that would be an additional sell signal, and then another potential trend line right there. All right, let's wrap it up here. Those are the ones I covered on the post this morning, and I'll just follow up any other stocks scheduled to report this week that stand out that we might see some trading ops. I'll follow up either in the trading room or on the front page with those. So that's it, guys. Just the takeaway is keep things light this week, but have your ducks in a row. Have your setups ready to go, ready to pull the trigger. Maybe it's more the same for another month or two with this market slow grinding higher, or maybe just one day out of nowhere there's a bang and we start a nice correction that, like I said, has the potential to wipe out weeks, maybe even a month or more gains in very short order, because the charts are certainly set up that way now with a lot of key stocks trading just above uptrend line support, the markets, the tech sector, everything else there. So that's it. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.